Silver is closing in on a major psychological milestone, $40 an ounce. It's a level we haven't touched in over a decade, and depending on who you ask, it's either long overdue or dangerously overheated. Earlier in the year, most analysts expected we'd get there, but not like this. The catalyst behind the recent breakout caught nearly everyone off guard. So what's really driving silver's latest rally, and more importantly, what does it signal for the back half of 2025? If you're serious about precious metals, you're in the right place. And if you want to help keep this channel alive and ad-free, subscribing goes further than you think. Thank you. Now, a quick note, there's always a slight lag between when we shoot and when these videos go live. Meanwhile, metal prices move by the minute. At the time of this recording, gold is charging toward $3,400 an ounce, platinum is flirting with $1,500, and silver is knocking on the door of $39. The whole sector is moving, but silver has taken center stage. Momentum is building, expectations are rising, and for the first time since 2011, $40 silver is starting to feel inevitable. We've said it before, plenty of analysts called for $40 silver in 2025. What none of them could predict were the repeated body blows from US trade policy. When Liberation Day tariffs were finally unveiled, the numbers were bigger than anyone expected. Gold stole the spotlight at first, as fear, confusion, and a lucrative transatlantic arbitrage sent prices soaring. The exchanges needed to stockpile gold in the event tariffs would impact cross-border deliveries and threaten the obligations made in futures markets. This had a predictable effect. Regional needs generated premiums among some of the biggest gold buyers in the world, and prices reacted as expected. But silver's story has been more of a slow burn, set in the now familiar landscape of delayed deadlines and escalating rates. When tariffs were officially pushed to July, there was optimism that trade deals would be reached and the impact would be modest. But new numbers came in. Headlines screamed 30% on Mexico, 30% on Europe. The market reaction was immediate and brutal, and the pain can be felt in the numbers. Silver lease rates have more than doubled to over 6%. It may sound like a technical detail, but it's a distress flare to savvy market watchers. Lease rates are essentially the interest institutions pay to borrow physical silver, most importantly used by exchanges to make sure they can fulfill delivery when futures contracts come due. Most traders roll their contracts forward and they never take delivery, but when someone does want the actual metal, the system has to make good on that promise. Lending metal is like greasing the cogs in the machine so everything keeps running smoothly. Normally, leasing silver is cheap because there's enough of it moving through the system. But when lease rates spike like this, it signals something has gone wrong. Physical holders aren't just unwilling to lend. In some cases, they simply can't. What we're seeing now is the fallout from a global realignment in trade. As tariffs rise and political risk escalates, metal that once flowed freely across borders is once again getting locked down. It's a combination of strategic stockpiling, regional dislocations, and a market reacting to recent developments in an adjacent market. Copper wasn't supposed to be on the chopping block. Markets did not expect copper to make the list of specially targeted tariffs. The July 8th announcement of a 50% tariff on copper imports sent prices surging. And copper isn't a typical trade war weapon. New mines take 7 years or more to develop, and supply chains are deeply embedded. Copper prices responded, but it sent signals to investors in both platinum and silver as well. Silver and platinum may be monetary metals, but they are also key industrial metals. Silver has important uses in energy, while platinum is used heavily in the automotive industry. Trump 2.0 has been focused on improving the industrial manufacturing base domestically, and the tariffs are his vehicle of choice to make good on his promises to Middle America. In a very real sense, silver and platinum have a lot in common with copper if the intention is to source key resources at home. So if copper could be targeted in global trade negotiations, it reinforces that nothing is off limits. Platinum or silver could be next. Institutions are paying close attention because even a modest tariff on silver would be devastating for futures exchanges where contracts are only as good as the metal backing them. This is why we're seeing a rush to stockpile silver and why holders are less willing to lease it. The key takeaway for retail investors is that prices currently include an uncertainty premium. Once the rules of engagement are clear, whether it's tariff or no tariff, markets will adjust and silver prices may retrace. But until then, the risk premium is real and reflected in silver bullion everywhere. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.